The truth is that most folks in their 60s don't know how to take money out of their retirement savings to generate cash flow, to generate income for them in retirement. I see this problem again and again. You saved money in 401ks, IRAs, maybe cash at the bank or in brokerage accounts. Maybe you've inherited some money and you don't know when you should take the money out, which investments you should sell. You kind of just have a haphazard approach to it. And I'm telling you, you're leaving a lot on the table, not only from a tax efficiency standpoint, but maybe even more importantly, from an income and cash flow standpoint. I want to share with you today some insightful, actionable tips that can really save you money over the long term. Let me tell you a story about a fictional person named Elaine. She was 67 years old, and the problem that she had when we met together was that she was taking money out of her traditional IRA instead of her taxable account when she first retired. That's a pretty big problem for many retirees if they have those two assets. And I'll show you the reason why. It would have been much better for her to take money from the taxable accounts first and defer the IRAs for continued growth later on down the road. So let me tell you a little bit more about Elaine's situation here. Recently retired, 67. Just her. She has half a million in a traditional IRA, 200 grand in a Roth, 250,000 in a taxable brokerage account. She does not have a pension, but she does have Social Security. In fact, she started it right when she turned 67 at her full retirement age. The goal is to withdraw from her savings enough to supplement the Social Security that she's already receiving and maintain her lifestyle. Of course, it goes without saying she wants to keep her taxes low. She needed about $40,000 a year on top of her Social Security benefit that she was receiving to cover her living expenses. So you have Social Security, and we need additional 40 grand. Without a clear strategy, Elaine just started withdrawing equally from all the different accounts. In fact, most of it was coming from her IRA. And remember, every dollar she pulls from a traditional IRA is taxable as ordinary income in the year that she takes the money out. So that $40,000, let's just assume for a moment that she took all of it from the traditional IRA. That 40 grand would look as if she earned and made 40 grand in those years when she was working. Remember, she put the money in pre-tax and now it's taxable to her at distribution. Not just what she contributed, but all the earnings and all the growth are taxed at the ordinary income rates. She pulled money from the traditional IRA because she thought it was the easiest. I mean, her mind, that was their retirement account. That's the place that she'd been saving for decades. And she had an old 401k. She rolled that into an IRA from a previous job. She just thought, hey, that's the first place you go when you retire. Unfortunately, it was costing her thousands in taxes and in opportunity costs because that money was no longer growing tax deferred. Remember, an IRA is a tax sheltered account because you're not taxed on the growth until you pull it out. So all the dividends, all the interest and the capital gains that she was getting inside the IRA, those are not taxable to her until she takes it out. She avoided she avoided touching her taxable account because she was worried about the capital gains tax that she would pay. She knew that it was a brokerage account or a taxable account's another name for it. She knew that there would be taxes to pay, but she wasn't sure exactly how they worked and she didn't want to, fumble the ball. She left her Roth IRA completely untouched during this. I mean, it was pretty much all coming from her traditional IRA, a little bit here and a little bit there, but pretty much all from the IRA. And the Roth IRA, she always thought of as last resort money. Now, let me pause here. In many situations, that can be wise to delay taking money out of the Roth until later on in your life. The reason being, the Roth account grows tax free and there are no required minimum distributions on Roth IRAs like there are on IRAs and other pre tax retirement accounts. So on this, she was on the right train of thought. I mean, she was thinking correctly to allow that money to grow tax-free into the future. But you'll see in just a moment why taking a little bit from the Roth actually would be advantageous to her, even in the early years of her retirement. Okay, the mistake she made. She took too much from her traditional IRA early on. It increased her taxable income. It bumped her into a higher marginal tax bracket. And the kicker is it triggered Medicare IRMA for her. These are surcharges that caused her Medicare insurance premiums to go up. Because remember, if you're taking money from an IRA that's generating income, the more income you have for tax purposes, the more you pay for Medicare premiums. By not using her taxable account strategically, she missed the opportunity to harvest capital gains at a 0% tax bracket. She didn't have a bunch there, but she had a couple of $1,000 that she could have harvested at 0%. And we could have done some tax loss harvesting in those years in which the market or some of her investments were down. Let me just speak for a moment on capital gain harvesting. Capital gain harvesting is oftentimes a great strategy for many individuals immediately after they retire because their income is now lower. In the capital gains tax brackets today, there are only 3 of them. With ordinary income, there's a bunch, but there's only 3, 0, 15, and 20%. And so for her in her situation, because her Social Security was where it was at, and she only needed another $40,000 of income to live on, she could have harvested some of those gains at 0% and some at 15, which for her was quite a bit lower than her ordinary income tax bracket that she was in related to the IRA distributions. And you can do some planning here because every time you invest in a brokerage account, you have what's called a lot history or a lot summary. Each lot represents a time that you buy an investment. So for many folks like her, they invest a little bit every paycheck or a little bit every single month. And each time you invest a little bit every month, you're going to have a specific lot, and it's going to say, here's what you bought the stock for on this day. This was the price, and it will tell you your basis. In other words, the basis is what the IRS looks at to determine how much gain you have or how much loss you have. For most people, it's what you bought it for. Alternatively, if you have dividends that you're receiving inside of a brokerage account and you're reinvesting those dividends, as they get reinvested, have their own lot. And so you can look at a lot summary in a brokerage account and see which positions you own, and you can use specific identification to sell this position or that one. I do it all the time with the clients that I work with. If we're trying to take advantage of tax gain harvesting, then typically we want to sell those positions with the largest gain. And so I'm going to go in and see what those are. Oftentimes, those are the positions we bought a long time ago. On the flip side, if I'm trying to minimize the gain and just generate cash flow for a client, so we're not doing tax gain harvesting, we're just trying to generate cash flow in a tax efficient way as soon as possible, then I'm going to look at those positions that I've held on to typically for at least 1 year or more so that I can get that favorable long-term capital gains tax treatment. And likely if I, just bought it a year ago or 2 years ago, something like that, well, now that investment has potentially a pretty small gain because I didn't buy it long ago. And if you just assume you invest for a long period of time and things go up, this example works well. Now, of course, there's other investments you may own in a brokerage account. And depending on what you own and how it's performed, we may do a combination of selling different lots of different investments. This is one reason why holding on to a large position of target date funds inside of a brokerage account is not advantageous. Now, if you're just starting your investment journey and you want a simple, straightforward way to invest, then I think a good low cost stock index fund or a good low cost stock target date fund can be wise. But if all you have is just one or two or maybe even three investments within your brokerage account and you're approaching retirement, you may be leaving some money on the table because you don't have the flexibility to pick and choose which positions to sell. Imagine for a moment an individual who has one brokerage account and all that money is in one target date fund. And then another individual who has one brokerage account and they've got a dozen different funds. On the whole, they're both diversified. They both have a good mixture of international and small and large companies. Maybe they have a little bit of bonds in the mix, whatever it is. From year to year, as we're generating income for both of them, the individual that has all their money in one target date fund does not have the tax flexibility to go in and pick and choose which investments they sell. It's one fund. Yeah, they have different lots, but they don't have as much tax control over how they sell their investments and the tax consequences they'll face. Compare that with the individual who has a dozen different investments. They're just broken up. Instead of it all aggregated in one mutual fund, they have multiple different ones. Well, now we can go in and strategically sell those investments to generate cash flow and at the same time adjust our portfolio to get the right mix, which sometimes we call asset allocation adjustment. That's a big nerdy term. It just means that sometimes stocks do really well and bonds don't have their time in the sun yet. And we want to just tweak that a little bit because now all of a sudden the portfolio has overweight stock in it. And we want to sell some of that stock and get back to our target mix, whatever that is. Hopefully you understand what's going on. When we talk about taking money out of accounts, it's certainly there's an order of operation to it, as we've just described with Elaine. But it's also making sure that we have the right types of investments in these accounts. If you have a target date fund inside of an IRA, it doesn't matter as much because remember, who cares? The investment's up, down, left, right, doesn't matter because it's all taxable as ordinary income. And our hands are kind of tied from a planning standpoint. But in a brokerage account, we have a much more control if we do it the right way. Now, if you're sitting here listening to this and you're saying to yourself, boy, I've got all my money in my brokerage account in one or two mutual funds or ETFs, it's not the end of the world. I'm not suggesting you go out and sell everything and start from scratch because that could potentially generate a taxable event for you. But it may be wise over a number of years, over a period of time, to transition out of just a one or two fund approach into something a little bit more diverse. And it's purely for a tax saving reason. Okay, back to our friend Elaine. Remember, she's 67. She's retired. She needs $40,000 to live on top of her Social Security that she's already receiving. And she delayed taking money out of her Roth IRA. Remember, on the face of it, I'm with her 100% because it's nice to have that money growing completely tax-free. But for her, it would be wise to take a little bit, a small percentage, and we'd run the numbers to determine exactly how much that was as part of her financial plan. But it'd be wise for her to take a little bit from the Roth in those early years to mitigate the additional costs she was facing from her healthcare premiums. And certainly if she were to retire before the age of 65 and jump onto an Affordable Care Act plan, an Obamacare type plan, then it'd be also important there as well. But those IRMA surcharges are based on taxable income, essentially. There's a few adjustments to that, but it's essentially the amount of income that you're taxed on, whereas Roth IRA distributions do not negatively impact how much you pay in Medicare premiums. In fact, they make it better. And that's exactly why taking some money from a Roth in her situation would be wise. Now, for some of you, it's not going to make sense at all because of the financial situation you're in, how much you're taking money out, where you have money saved. In fact, we may want to do Roth conversions. We may be trying to add money to a Roth at this stage in your life rather than taking money out. But for Elaine, Roth conversions did not make sense in her situation. They just plain and simple did not make sense. And it really was a combination of how much money she needed to live on in retirement and how much she already had saved. Why does this matter? At the end of the day, the order and source of withdrawals or income for you in retirement impacts your total taxes paid, affects your Medicare premiums, and can either reduce or increase the amount of your Social Security that's subject to taxation. A tax efficient withdrawal strategy matters and can extend the life of your retirement assets for a number of years if done correctly. I mean, this is your time, energy, sweat, and maybe tears reflected in the amount of money you have saved for retirement in these accounts. And the longer we can stretch that out, well, the more, stress-free retirement you can enjoy without having to worry about running out of money. And coordinating the withdrawals from year to year matters as well. Okay. Tax law changes, it adjusts quite often. And so does your life. Maybe it's not just a flat 40 grand that you need on top of Social Security. Maybe one of those years you need a new vehicle, or you need to do a remodel on your bathroom or kitchen, or maybe you want to go with your kids and go on a fun cruise or travel to Europe. You may see a higher need for cash flow in those years, and we would adjust depending on your situation. It's not just understanding your income tax consequences, as important as that is, but also the other things like healthcare related costs as well. My name is Rizik. I'm a financial advisor, CPA, and certified financial planner. If you enjoyed this, you're going to love my new book, Finance on the Fly: Simple Strategies to Build Lasting Wealth. I think you'll really find it an insightful and eye-opening plain English guide to helping you make smarter, more confident decisions as you plan and enter retirement. If you know someone who could enjoy this, please share it with them. It will be a valuable resource to them as well.
The Finance on the Fly podcast is for educational purposes only. Any ideas presented are not intended to be personalized financial, tax, or legal advice and are provided for informational purposes only. Rizik is not rendering or offering to render personalized investment, legal, or tax advice through this content. Investing comes with risk, including the risk of loss. Consult your own tax professional, financial advisor, or estate planning attorney to perform your own due diligence.